Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. I've got a lot of questions here recently, and I've had a lot of subscribers express concerns about I've been talking quite a bit about how highly valued or even overvalued the overall stock market is right now, and how I've also picked and talked about select stocks that were way overvalued. And so I've had a lot of questions about that and a lot of concerns and questions even about what should I do if it happens. And I recently, just yesterday, got an email from a FastGraphs subscriber, and I hope you don't mind me calling out. His name was Mark Brady, and he's been a subscriber for about 6 months. And he suggested that I might do a video talking about what would happen during the recession or during a market crash more specifically. And as a value investor, how would you deal with that and how valuation can actually protect you during those kind of catastrophic events. And so I thought it was a very interesting subject matter, but more importantly, one that's very near and dear to my heart. So what I'd like to do is go ahead and go through a presentation I put together here with this video that provides the 4 reasons why I do not fear a market crash. Okay, and a lot of it has to do with being a value investor. Because I really believe, and I'll be illustrating this as clearly as I can, that market crashes and even recessions, if you're a long-term oriented, value-oriented investor who's investing for the long term, actually relishes the fact that you get a market correction or even a recession. And I'll give you the reasons why I think that's right. Everybody's afraid of it, I know that, but I'm going to try to take some teeth out of that paper tiger here, if you will, with this presentation. So let's go ahead and get started here. Reason number 1 is that you've heard me say so many times, it's a market of stocks and not a stock market. With this video, I'll be showing you examples of how different common stocks are and how not all common stocks, react with the market. Now, if you got a crazy, rising or falling market, like over a short period of time, a flash crash, like we saw with the COVID-19 pandemic, for example, you will see, stocks falling pretty much in tandem. But the key is, if you're talking about an overvalued stock falling from being highly overvalued, that could be a very long-term problem, where if you have a fairly valued or a stock with a margin of safety that's undervalued and it gets caught in the initial, downswell, they tend to recover much more quickly. And as long as the fundamentals are intact, those turn out to be buying opportunities rather than selling opportunities. And I'll get into that a little bit also. My second reason is that I only invest with a margin of safety. I believe that the best offense is a strong defense, if you will. And what I try to do is only invest in extremely high quality dividend growth stocks, especially more recently, at very attractive valuations. So I have a margin of safety and I already have a defensive posture that kind of relates to what I just said a moment ago. In other words, they might fall with the overall market in an initial downswell, but I would argue not only will they recover quicker, but they will eventually recover and go on to new highs, where if you had overvalued stocks that were massively overvalued and they corrected, it may take years and years and years before you ever get back to what the valuations were before the market crashed. My reason number 3 is the predictability of dividends. One of the things that, has really proven to me over the 5 decades I've been doing this is that if you own blue chip, high quality dividend growth stocks, especially stocks of the ilk of the Standard & Poor's dividend aristocrats, which are companies that have increased their dividend for at least 25 consecutive years, or there's also another list that I follow by an associate of mine, Justin Law, who's the curator of what he calls the CCC list, which are the dividend champions, challengers, and contenders. These are all companies that have had long histories of raising their dividends. The champions, just like the aristocrats, have done it for at least 25 consecutive years. And these companies tend to do this right through the recession. So if you're investing for income, even though the stock price may temporarily fall, your dividend income can actually be increasing. That's the third reason I don't fear a market crash or a recession. And then finally, and I think this is really an important reason that I think is really the foundational reason perhaps, and that is, if you look at things historically, bull markets tend to last a lot longer than bear markets. Bear markets tend to be very short-lived. They can be very devastating over the short run, but then they almost always lead to a longer-lasting bull market. And so what they really do then, from that perspective, if you have the right approach to it is they create great buying opportunities for you to, get money invested or reposition your portfolio or whatever. So, I'm not afraid of bear markets and I'm not afraid of recessions. Now, I found this graph. Now, this is a dated graph. This only goes back to August of 2012 and only updates through 2012. So I'm missing, the latter part of this decade here, but I'll be filling that in for you. What I really wanted you to see here was the idea that each of these gray shaded areas, of course, are recessions, and to point out that, typically recessions, the gray shaded area tends to be reasonably short-lived, and then the bull market that follows tends to be very long-lived. Now, in 1970 to 75, it was shorter. We had a severe recession, but then we had several years, and then 1980 was a pretty wacky time period with interest rates at all-time highs, et cetera. And then we had a recession that was very short, led to a short bull market, came to another recession, but then we had this very long extended bull market following that. And then, of course, when you get down to, the 1990 recession, it was very, very short-lived, and it led to a very extended bull market. And then we had the 2001, which was also predicated by the irrational exuberant period. Now, there's something interesting about this. You don't really see it on this graph, but you sort of do. This was a period of really excessive overvaluation. I want to comment on that a little bit later. It led to a very strong bear market, but then it was followed by a very long-running bull market. And then we had the Great Recession, which really was only probably exceeded by the Great Depression. That's why I like to refer to it as the Great Recession, because it wasn't like the full depression that we had in the late 20s and 30s in this country. But now that's led to an extended bull market. Now this only goes through 2012 or so, but of course we know that bull market has run all the way through. So let's go ahead and look at the current state of the S&P 500. As an aside, and before I get too far into this, I'm going to be utilizing the new version, or the new soon-to-be launched new version of fast graphs that we're working so feverishly on. We've got the historical graphs pretty much working. We've got a lot of work going on in the portfolios. In fact, I'm going to be using the Dividend Champions portfolio here that I've got in here. We've got all these other portfolios preloaded. We're making really good progress, but we're not ready to launch this yet because there's still a lot of work that our developers have to do, but we hope to get this launched very soon. Things are happening very quickly, and the reason I'm doing this is I'm getting a lot of questions, asking when this is going to be launched. So I can't give you that time frame yet, but I am going to tell you that, as you can see by using the tool here in this video, that it's getting a lot closer. But let's go to the S&P 500 index here, and let's look at a couple of things that are very important. And for those who are not initiated to the fast graph tool, the orange line represents the intrinsic value, or what I like to call the fair value of the market. The blue line is kind of a market. We call it the normal PE ratio, but it's actually the market PE ratio. So, when the market, in other words, overvalues a stock beyond intrinsic value or undervalues it below intrinsic value, we'll see that. And on average, we see the market does have a penchant to overvalue stocks more than it does undervalue them. I will admit to that. But here's a point I want to make about this when I'm looking at this graph here. Now, when I say I don't fear recessions, they are kind of like the pause that refreshes, but like, for example, they're not all the same. Just like it's a market of stocks, it's also a market of recessions. For example, back in the irrational exuberant period here, we had a very highly valued S&P 500. By the way, the blended PE was 24.99, or we'll call it 25. Okay, the current blended PE, just as a perspective, is 26. So take that into consideration. That high valuation in the market back then in 2001, as we came into 2001, and you can see this spanned, about 8 or 9 months of the year here. We had a period where we did have stock prices drop, but look at the, level of the S&P at that time. It was 1366. And I go all the way out here, I could keep going out and keep going out. And I've got to go all the way out to roughly June of 2012 before I get the market back to the level that it was. Now, there was a time when it did reach it just before we came into the Great Recession. So I want to be clear, but this point is this very high level of valuation did lead us to what many refer to as the lost decade, which really was measuring stocks a little bit, earlier than I've listed here. But I just want you to get the impact of that. high valuation is something else you have to take into consideration. In other words, a market that falls from being very highly valued is more dangerous than a market that falls from being reasonably fairly valued. Now, the Great Recession actually happened at a time when the market was reasonably valued, and it did have a huge drawdown. But I also want you to notice in this example that the market actually did recover a lot quicker than what we saw with the previous recession because valuation was in better alignment. Okay, that's a critical point. But again, I want to caution you that the market is extremely overvalued today, even a higher PE ratio than we had, during the irrational exuberant period of 1999 and 2000 and coming into the 2001 recession, which obviously changed everything. But the reality of it is valuation matters, and it matters a lot. But the point I want to make is the recession was very short-lived. This is updating the chart that I just showed you a moment ago in my little slides. Here's a short recession, led to several years, 7 or 8 years. Let's see, 1, 2, 3, 4, 5, 6. 6 years of strong bull market once the market got into fair value. Then we had the Great Recession. It reset the market again. And now we've had this very long-running bull market. Now, it was temporarily interrupted by the COVID pandemic. And a couple of things about this is I want you to note that the earnings of the S&P 500 actually dropped in 2020. The dividend dropped in 2020 as well. It was cut slightly from $58 a share to $56, an index share, if you will. The actual drawdown of the market, which happened, very, very quickly here, you can see this was about a 20% drop, if you will, annualized at almost 60% because it happened so quickly. But it was roughly a 20% drop. But then it didn't take very long for the market to get back to where it was and higher than it was before the drop. By July of 2020, we were back. And then, of course, we've now gone on to all-time highs. So the point is, this was a flash crash, but here's what I want you to notice. Even if you look at the general market here, the overall S&P 500, and look at the dividend record even here for the average is pretty, benign. In other words, dividends continue to be paid. They were temporarily interrupted a couple of, during both of these last two recessions. They actually grew the dividend during the 2001 recession. The S&P did, I might mention. But the point is, even the index itself has a pretty good record. But let's talk about dividend champions here because, one of the reasons I gave you was if you invest, dividends are very predictable. And if you invest in these supreme dividend champion type stocks, you're going to go through these markets without a whole lot of stress. So let's start with a relatively straightforward A-rated Kimberly-Clark. And I want you to see a couple of things about what happened during the recession. It actually hit the Great Recession with the stock price pretty reasonably valued. The black line was, touching the orange line. We did see a big dip in price here, but then we saw a very quick recovery. We saw earnings fall only ever so slightly by about 2.5% in 2008 over 2007. So it was very minimal effect that this quote unquote Great Recession had. People, needed their toilet paper and their paper towels and their diapers and so on. But the market did react, but the fundamentals stayed strong. The dividend actually grew. And it also grew during the flash crash. In fact, we didn't even have a flash crash from a standpoint of fundamentals. We actually had very strong earnings growth. We all know, the paper towel shortage that happened. But the point is, I don't fear these recessions. I look at them as buying opportunities. I got an opportunity to buy this stock at an attractive valuation for the first time, maybe over this whole 2 or 3 decade period of time here. So I don't fear recessions because if I'm buying the right kinds of companies, the fast food chain McDonald's, which I consider to be significantly overvalued today, it went through the Great Recession virtually unscathed. It did have some slight downward pressure on earnings during the '01 recession, but it still stayed very, very profitable. These were still some of their most profitable years they ever had. They did raise their dividend all through that. They raised their dividend all through the Great Recession, and they raised their dividend through the flash crash. So the point is, you even though you got a short-term drawdown here, it never even got close to being attractively valued. And so, the recession / flash crash didn't really hurt them very much at all. And then you look at the mighty Walmart, this is a story, I tell this often about valuation. There was no recession in 2001 for Walmart, and the company did raise their dividend through it. There was no recession for Walmart during the Great Recession, and their stock did drop from being moderately overvalued, but it actually stayed fairly valued all through the recession. It held its value. Certainly the dividend increased every year, so it really was a non-event. And then even during the flash crash, we had very, very little, stress on Walmart, as a mega retailer here, and that's notwithstanding Amazon, et cetera. And then, I can take another look at a stalwart like, Coca-Cola. And here you see again, exactly the same story again. You did see a little bit of an earnings dip during the 2009 recession. I believe the stock was fully priced back here. I didn't say overpriced because you'll notice this stock tends to be given a premium valuation. There's a whole lot of reasons for that. The quality of the company, the predictability of it, even the fact the value of their brand would possibly have something to do with it. But the recession actually would have given you a chance to buy it at an attractive valuation relative to other companies growing at the same rate, et cetera. But nevertheless, it went through the recession, increasing its dividend each year. It went through the flash crash. It did have an initial drop in value, just like most stocks did. It did have a minor drop in earnings. It still stayed very profitable, but had, by this time we're looking at maybe the third most profitable year in recent history. But they did maintain and actually increase their dividend from $1.60 to $1.64 to $1.68. And you can see the stock has held up very, very well. So I'm not really fearing a recession, for those reasons. These really high quality stocks, here's Clorox, another blue chip that trades at a premium valuation. And obviously this from a COVID point of view, Clorox actually had a pretty good year in 2020. I shouldn't laugh. I really shouldn't. Because, just the idea that everybody was sterilizing everything. And of course, the stock rallied very strongly. It actually benefited. But the point is, this is, an ongoing recession. This recession isn't over. This was the Great Recession. This was 2021. And we saw very, very little stress. And we certainly didn't see any stress with their dividends. They not only maintained them, they continued to pay them. So, the reality of it is if you invest for the long term and invest in good dividend paying growth stocks, you've got the opportunity to make money and you got the opportunity to walk through even a recession. The key is if you only are buying these stocks when their valuations are sound, then even then the recessions really don't hurt you, nor do the crashes in the market, because you'll tend to recover, very, very quickly. Now, I've talked about this one quite a bit in the past, and I'm going to show it one more time here because I'm not going to be able to show this much longer. I'm going to show Cisco, the tech stock, and I want to make a point. When you have overvaluation and you hit a recession like we did in 2001 with Cisco, this stock has yet to recover back to what it was back then. So you also always got to take valuation. This stock was heavily or very highly valued coming into the Great Recession. And as a result, this led to years of very poor performance or very weak performance because, the recession hit it very hard, but then it also, it took years and years for it to recover. So overvaluation, very, very dangerous regardless. Now, when you buy these things, when they're undervalued, during even these recessions, you can recover very quickly, as you can see here during the pandemic or even during the great market crash. It didn't take you long. You could have actually sold at a profit. Now, it did get weak again, but, almost no matter where you measured this here, you would have made a double-digit decent rate of return owning Cisco as long as you bought it at an attractive valuation. Of course, it didn't start paying a dividend until 2011. But this other notion that I want to, come back with is that it's a market of stocks, not a stock market. There's a lot of differences in common stocks out there. If I look at a stock like U.S. Steel, what the stock market's doing really has very little correlation or relationship to U.S. Steel and what its business has done. You can see the volatility of earnings, the volatility of price, the fact that, performance over long extended periods of time has actually been extremely poor because the company finds it very difficult to make sustained earnings. You can look at another cyclical like Kaluka and Safa, And you see, again, a situation where, earnings very now, this stock did rally quite strongly recently on very strong earnings growth, but it's very, very unpredictable is the point that I want to make. You've got automobile manufacturers like Ford Motor that really haven't, there's no relationship to this and the market, or there's no relationship to this kind of company. And for example, a company like AmerisourceBergen, which is just a, awesome company that, just has consistently grown earnings year after year after year. And once again, they went through the recessions like they weren't there. From an earnings point of view, they had strong earnings growth. During the flash crash, there was no drop in earnings. There was no drop in dividend. In fact, they raised their dividend, over that period of time. There's a big difference between this kind of company and the other kind of companies that I've shown you here. So I'm not really fearful of market crashes, and I'm not really fearful of, recessions because A, they don't last very long. Two, it's a market of stocks, not a stock market. I try to be very, very defensive and make sure I buy high quality blue chip growing stocks. Additionally, I try to look for companies that give me a margin of safety. I only want to invest when I can buy these stocks at very attractive valuations, like a Bristol Myers today. I can buy it so far below earnings that I'm making a really good buy. I've got names, high quality names like Prudential in the insurance industry. If I'm buying these stocks with these high margins of safety, I've got a very good chance of not having to worry too much about these recessions. The companies pay good dividend records. Now, Prudential did cut their dividend during the Great Recession because it was a financial, but you can see it, immediately started increasing the dividend again. So this would have been a slight interruption. But again, it didn't devastate the portfolio like a lot of people, I think, are fearful with these recessions of how bad they can be. But dividends are predictable. They're not perfect, but they are predictable. I think that's, another reason that I like quality blue chip dividend growth stocks, and the fact that I invest for the long run, because bear markets and recessions tend to be much more short-lived, especially in modern times, than the bull markets, and the bull markets tend to run. So if I can get a chance to buy these stocks at low valuations, all the better. Now, I'm going to shift gears a little bit, because what I'm also trying to do here is showcase and give those of you who are as frustrated as I am, and I will give my development team credit. They're working very, very hard to get this thing launched. It's an extremely complex tool. The new version of Fast Graphs is going to be awesome. Our portfolio section is going to be significantly improved. Our financial underlying numbers section is going to be significantly enhanced. We're going to be offering several more metrics. None of this has actually been stylized yet or organized yet. We're just getting the data loaded and begin working on it. But we're also going to be adding some very significant enhancements. For example, all subscribers, basic and premium, are going to get our sales valuation reference tool here. And what this is this is essentially a price to sales graph, if you will, but a price to sales graph on steroids. Okay, here's Apple. I've argued that Apple's overvalued. This is Apple based on its normal price to sales historically. You can see that it's just another way to tell you that this is my favorite company in the world, but it's overvalued. On the other hand, you can look at a stock like Amazon, which I've often talked about, because he being Jeff Bezos, wasn't worried about profitability at first. He was primarily worried about revenues. Well, this is sales. And so I want you to see that, this company, even though it would be highly valued here because the sales growth, if it moves on to its normal price to sales going forward, it would still be a positive rate of return generator. But another thing I want to show you here about this price to sales metric is that we're also doing something that I've not seen anyone else do, and that's we're giving you a dividend payout ratio. How much of their sales are they paying out? We know, we all see earnings payout ratios, but here's a dividend payout ratio in sales. So, Johnson & Johnson pays out, about, well, let's go ahead and look at it, from the thing. They pay about, 7 to 10% or so of their sales they pay out to us in dividends, which is kind of interesting. But again, this gives you another perspective evaluation, and all subscribers will have it. So, I hope this helped you not be as fearful about corrections and market crashes as perhaps you might have been before watching this video. I don't fear them. I actually relish them. I talk about living in money manager hell. I tend to be, giddy and euphoric when my clients tend to be depressed and scared to death. And when my clients are depressed and scared to death, I tend to be giddy because that's when I'm able to buy great stocks when they're on sale. And that's what I see recessions and bear markets giving me. That's the opportunity to invest when I've got a margin of safety and I can make good money. That's when I like to buy stocks. And, so I look forward to recessions because I'm going to be a long-term investor. I plan on holding on to my company for years, and therefore I'm not afraid. I don't buy these stocks to sell them. So just because their price temporarily drops doesn't scare me very much because I'm confident as long as these fundamentals stay strong, my stocks will eventually return back to their intrinsic value, and I'll do fine in the long run. Anyway, it's been Chuck Carville saying thanks for watching. Ring the bell, give me a thumbs up and a like, and subscribe to the channel if you haven't. We've got some exciting things coming down the pike, including the new version of Fast Graphs. And of course, I think those of you who've been suffering with the current version, which I consider to be an awesome tool, by the way, I don't want to denigrate it. This new version is so much faster and it allows us to be so much more efficient in valuing stocks that I think, it's going to be worth waiting for when we finally get it launched. Thanks for watching.